Hi, I'm Tom Briney, Portfolio Manager for the Strategic Credit Fund. Today, I'm going to walk you through an overview of the fund. Before we start, I'd like to take a brief minute to walk through the agenda for this presentation. We'll start with a fund overview, move on to the benefits of focusing on multifamily, next to the fund strategy, which includes securitized products and direct financing. I'll then briefly touch on Origin's proprietary forecasting model, Origin Multilytics, and then finish by going over the fund terms. Let's talk about the three main benefits of this fund. The first is downside protection. Credit in general has a lower historical loss severity than equity. Equity can be a more frequent and a larger loss than you would experience in most credit situations. Multifamily, on top of that, offers even more protection than if you were investing in office or industrial or retail. And so that's additional downside protection. We'll talk more about that in a minute. This fund also offers monthly distributions. Most of the returns in this fund will be received as monthly distribution to investors. However, investors in the fund will have the opportunity to drip or dividend reinvest their distributions back into the fund. That will allow investors to take what would have been cash distributions and put them back in the fund on a monthly basis and generate that compounding return that can be so powerful. And finally, there's an inflation hedge component to this fund. It was designed and created with the flexibility to take advantage of both rising and falling interest rates environments. This is an actively managed fund. We'll be buying both fixed and floating rate products. And we saw this strategy play out extremely well in Origin Multifamily Credit Fund, which has so far invested $243 million in Freddie Mac bonds, both fixed and floating. That fund is returning consistent monthly distributions at or above the expectations we provided to investors when we launched that fund. Finally, in this fund, there'll be more than $10 million invested by the senior leadership group of Origin and Origin Credit Advisors over the next 12 months. So our capital will be aligned with your capital. This fund is specifically focused on multifamily, which is relatively unique to credit funds in general. Why only multifamily? Well, if you look at the chart on the right, you'll see the return profiles across the four major food groups since 1990. So that's multifamily, industrial, retail, and office. On the x-axis is the volatility or the distribution around those returns. And on the y-axis, you can see the total returns of those product types over the last 30 plus years. You'll note that the multifamily circle is in the upper left-hand side, which indicates that it's got the second highest total return of the four major food groups, and it has the lowest volatility by a pretty wide margin of all the four institutional investment types. The reason for this is everybody needs a place to live. It's very difficult to disrupt housing, and everybody always needs a place to live. So this is an opportunity for us to invest in what tends to be a very strongly returning product with very low standard deviation. Multifamily is what Origin knows. It's what we do, and we do it extremely well. The fund strategy is really a combination of what we've been doing historically, plus an expansion on what we've done historically. There are two sleeves to this investment strategy. The first sleeve is securitized product, and the second sleeve is direct financing. Securitized product is really what we were investing in Origin Multifamily Credit Fund. That's the Freddie Mac bonds. In addition to those Freddie Mac bonds, we're going to add CRE CLO, or commercial real estate collateralized loan obligations. It's a fancy way of saying bonds that are just like Freddie Mac, but originated by somebody else. And so the originators of CRE CLO tend to be the likes of JP Morgan and Arbor Realty Trust and other very high quality institutional originators. We're adding these CRE CLOs for two main reasons. One is to capture the market dislocation. We've seen over time investing in Origin Multifamily Credit Fund that from time to time, there's really unique opportunities in the CRE CLO space where we can generate exceptional returns for the risk profile that we're taking. And so by adding it to this product to the fund, we're going to be able to capture those unique opportunities where there's a dislocation in the market and we can capitalize on it. The second reason is to preserve liquidity within the fund. This fund has liquidity options for our investors, and the CRE CLO product tends to be more liquid than the Freddie Mac bonds. And for this, and to make sure we always have the opportunity to provide liquidity for our investors to the extent that they're looking for it, as well as to make sure we can capitalize on any shifts in market movement, these liquid CRE CLOs are going to be a critical component to this fund. It's worth keeping in mind, however, that 90% of the fund will still be multifamily as collateral. So as I mentioned before, multifamily is what we do. It's what we do well. And this fund will be no different. Although we're adding product types, from a strategy perspective, we're still focused exclusively on multifamily, which means there's no office, there's no retail. This is our expertise. Multifamily is what we do, and we do it well. The second sleeve of the investment product is debt direct financing. And this is really two components, which I'll break down a little bit further in a minute here, but that's preferred equity and stretch seniors. The preferred equity position really is like a Freddie Mac bond, but instead of getting 20, 30, 40, 50 loans in a single pool, we're originating these pref equity positions one-off and allows for specific and diligent deal sourcing. The idea with this fund strategy is to maintain flexibility. That allows us to capitalize on opportunity and generate the highest risk-adjusted returns that are available in the market. By being able to swing between these two different sleeves of an investment product, we can capture the best risk-adjusted returns that are available in the market at any point in time. Let's talk for a minute about the history of Freddie Mac. For those of you not familiar with Origin Multifamily Credit Fund, this is the product we invested in and continue to invest in heavily in that fund. This slide shows the historical losses in the Freddie Mac program going back to 1994. If you look at, I want to draw your attention to two spots. First is the 2006 vintage pool. The column on the left in the slide here shows the vintage in which the pool was originated. That 2006 vintage pool is the highest loss in the Freddie Mac history at just over 0.4%, which is exceptionally low considering most of that loss was generated during the Great Financial Crisis. So it was originated in 2006, but the losses generally occurred between 2008 and 2010 in that vintage pool. And then I'd like to draw your attention to the bottom of the screen where we have the totals of 1994 through 2021. And the total loss across those 28, 20, going on 29 years now is 0.04%, or very, very close to zero. That's exceptional considering there's been almost $700 billion of origination over the last 28 years, yet the historical loss is just above zero, is a risk profile from a loss perspective that's very, very difficult or impossible to find elsewhere in the credit space. What's more unique about this is that the historical yields on this product has been anywhere from 7 to 15% range. So 7% in some of the tightest environment, like we saw in 2021 and 2022, and 15% or greater, like we saw during COVID or even the GFC. So why is it that with this risk profile, you can get returns which are so high? The answer is barriers to entry. In order to buy the Freddie Mac B-piece positions that we've been buying with Origin Multifamily Credit Fund and will continue to buy in Strategic Credit Fund, buyers must be approved by Freddie Mac. This approval process is extremely long and takes a lot of diligence, both from the buyer's perspective as well as Freddie Mac's perspective. And Freddie Mac does this to make sure that the buyer of their B piece is a good partner. They don't want to sell their bonds to any individual on the street. They want to make sure that they know who they're selling their B pieces to, and they believe in their operational expertise. So there's four main reasons or four criteria that Freddie Mac is looking at when they're evaluating a potential B-piece bond buyer, which is also known as a directing certificate holder, or DCH. The four reasons are listed out here on the left: operational expertise, Freddie Mac borrower, capital base, and long-term holder. They spent substantial time, almost 20 months, digging into Origin to make sure that we qualify for these four pieces. They've been diligent in their approval process. And in 2021, Origin was approved as a DCH. So that puts us in somewhat rarefied air, as there's only about 20 or 25 DCH holders in the United States at any given point in time, and Origin is one of them. Most people who say they buy Freddie Mac product are either not buying B pieces or are not buying the controlling interest. If they're not buying the B pieces, if they're buying the A tranche, you don't have to be a DCH, but your returns aren't what I mentioned before, 7 to 15%. They're much closer to the corresponding treasury plus 70 or 80 basis points. So today, if you were to buy a 10-year fixed rate bond from Freddie Mac, you're in that 4.25% to 4.5% range, not 10, 12, or 15%. Or they're in a non-controlling position. Origin prefers, in all cases, to be able to control our positions, to be able to buy and sell when we like to, and to be able to take over loans if there's any distress in a portfolio. So it is critical for us, should be critical for all fund managers to make sure that if they're invested in the B pieces, they are a DCH and have the ability to work out loans with the borrowers. And this is back to what I've been talking about. We understand multifamily, it's what we do, and Freddie Mac has agreed with us and they've approved us as a DCH. The second sleeve of the investment strategy is direct financing. We'll talk a little bit more about it here. Preferred equity is the most critical or the anchor piece to this investment strategy. This is something we've been doing for years and we've been very successful at it in that we've sourced quite a bit of it, hundreds of millions of dollars, and are an active player in the space. What we really like about it is that you can focus on acquiring one asset at a time or structuring one deal at a time. I like this because this rifle shot approach allows you to fine tune and really understand the risk of every single asset, every single sponsor, the locations, the margins. It's so critical to understand exactly what you're getting, especially with the sponsorship, because sponsorship, whether you're talking a fund sponsor or a property sponsor, can make or break a deal. And so we spend a huge amount of time underwriting these preferred equity positions to make sure that we understand those three things: the sponsor, the location, and the margins. The direct bridge is very similar, but rather than being in that B piece position as we are with the bonds, whether they're Freddie Mac, CRE, CLO, or the preferred equity, the stretched senior position is a full loan solution, all the way up to 75 or 80%. This is the first loan position where we control the entire first portion of the capital stack. So how do we process all this information? We've been talking a lot now about the strategy and the different components of the strategy. Let's talk about how we analyze all of this data. The way we do it is through Origin Multianalytics. This is a proprietary program that we created starting in 2019 that has proven to be exceptionally accurate with its predictions in rent growth and its identifying of risk assets. This product is used extensively as a risk evaluation tool across my team and the teams throughout Origin to help us quickly identify which assets, which locations, and which sponsors might be higher risk than a bond pool average or a portfolio average, and allows us to dig in to those risks quickly and flesh out if there's going to be any issues before we purchase a bond or before we issue a term sheet on any direct financing. A little bit on Multianalytics. We started this again back in 2019. We hired some data scientists to help us create a tool which is better than the market standards that were available back in 2019 and frankly that are available today. These data scientists that we hired are exceptional at the spatial econometrics space, which is a unique position, which is a relatively new field of econometrics. And these are the foremost experts in that space. And what they've created is a program that captures nearly 3 billion pieces of unique data every single month and regresses it back more than a decade. And it says, okay, machine, if you knew in 2010 what you knew today, what would you predict rent growth going forward? Or where would you identify risks going forward? And then it uses that data to project going forward from today for the next 5 years. In 2021 and 2022, we took a snapshot of our data. We compared it against the data provided by third-party providers of similar data, and the results were astounding. It wasn't even close. Origin Multianalytics was accurate with its predictions within $20 nationwide across all asset locations and quality types. That's astounding. The closest competitors were not within $150 or even $200 nationally of the projections that actually occurred. So not only were we more accurate at the national level, but it gets more and more accurate as you zoom into the submarket and even property level. This is a tool that we use on every single bond that we look at and every single direct financing that we execute. It's something that's critical to our business, and it really separates our risk management from the competitive set. As you can see here, there are the key terms for the fund. I won't read through all of them. You can read them here. The piece that I want to point out is the REIT structure. This fund has been structured with a REIT blocker in place, which reduces the income tax liability for the investors within this fund. This fund is available for investment through IRAs or other tax deferred accounts. So in those situations, the REIT blocker is less relevant. However, if you're investing via a taxable account, this will reduce your tax liability by 20%. We have made the assumption here of the top tax bracket and then being reduced from there. But if you're in a lower tax bracket, this will still continue to be the case. You'll receive a 20% reduction in the tax liability. This is part of the Jobs Act from 2017. It does expire, I believe, in 2026. But until then, this fund will be the beneficiary of those tax reductions. If you have any questions, please feel free to reach out to us at investorrelations@origincreditadvisors.com. Please note that it's advisors spelled with an E at the end as opposed to an O. If there's any questions, we look forward to hearing from you.